something strange happened to silver. On the surface, it looked like a total collapse. Prices dropped hard, and headlines screamed panic. 14% was wiped out almost overnight. Social media called it a bloodbath. Analysts declared that silver was finished, and retail traders were shaken out once again. But here's the thing. This was not a normal crash, because real crashes don't need emergency money. Behind the scenes, banks were scrambling for liquidity. Billions of dollars were injected into the system quietly, quickly, and without any press conferences. This wasn't to save silver. It was to save the very system that prices it. It was the paper silver market that collapsed first. It's not the physical metal, not the real supply, not the actual demand. Just confidence. Silver futures flooded the market all at once. This wasn't natural selling, it was forced selling. It's margin calls, liquidations, and algorithms hitting stop losses in a matter of seconds. This is how modern markets create what they call price discovery, by overwhelming belief with sheer volume. But there's a crucial detail nobody talks about. When silver truly crashes, the physical metal follows suit. Dealers slash their premiums, inventories pile up, getting delivery becomes easy, almost immediate. That didn't happen this time. Instead, the physical silver market went silent. Mints around the world slowed down their production. Delivery times stretched from days to weeks, then to months. And the premiums, the cost to buy physical metal over the spot, price refused to fall. Some even rose. This is the first major crack in the official story, because price is only real when the metal actually moves. And the metal wasn't moving. While screens in New York and London showed silver collapsing, real buyers in other parts of the world were paying more, not less, to get their hands on it. This was especially true in Asia, especially in China. China wasn't selling. China wasn't panicking. China was accumulating. They weren't doing it through futures contracts or They were doing it through physical delivery channels, quietly taking possession of real metal. While Western traders were dumping paper contracts in a panic, China was steadily absorbing the physical supply. This isn't speculation. This is strategy. Because China has lived through financial betrayal before. They've watched their foreign reserves get frozen. They've seen currencies weaponized against them and trade rules rewritten overnight. They learned a very simple, hard lesson. Paper promises fail under pressure. They saw an opportunity. They saw a controlled sell-off, a manufactured reset. They saw a chance to acquire a strategic material at a deep discount created by financial leverage, not by real-world fundamentals. And then something even more alarming happened. Silver stopped falling, but not because a flood of new buyers rushed in. It stopped falling because the sellers disappeared. At a certain price point, let's say $75 for argument's sake, silver didn't just bounce, it froze. The market seized up. That's not how free markets are supposed to behave. That's how exhausted systems behave. It happens when everyone who could be forced to sell has already sold, and the ones who actually needed the physical metal, well, they were no longer selling at any price. This is the exact moment when the entire narrative begins to flip, because when the paper price completely disconnects from the physical flow of the underlying asset, history tells us exactly what comes next. It brings violence, extreme volatility, and eventually a dramatic repricing. But before that repricing comes denial. This is the stage we're in now, the denial. Commentators will tell you it's just market noise. They'll say the fundamentals are weak. They'll point to industrial demand slowing down or some other convenient narrative. They will do everything they can to keep you looking at the flickering price on the screen and not at the empty vaults behind it. They need you to believe in the paper price because the entire financial system is built on that belief. Remember, the price of silver isn't just about a single commodity. It's a barometer for trust in the currency itself. If a physical asset with thousands of years of history as money can be so easily manipulated and disconnected from its paper derivative, what does that say about the stocks, bonds, and currencies priced by that same system? It says the foundation is fragile. The so-called crash wasn't silver failing. It was the system revealing its own weakness. It was a stress test that the system almost failed. The emergency liquidity was the patch to hold it together, to keep the illusion alive for another day. But the cracks are visible now, for anyone willing to look past the headlines. The divergence between the paper price and the physical reality is the most important signal in the market today. It's telling you that the game is changing. The people who control the physical metal are starting to dictate the terms, not the traders who swap digital contracts. The East is calling the West's bluff. What happened wasn't a silver crash, it was a warning shot. It was a glimpse behind the curtain of a leveraged, fragile financial architecture that depends on confidence far more than it depends on collateral. And when that confidence finally breaks for good, the repricing won't be a slow adjustment. It will be an instantaneous, violent reset to reality. The question is, will you be positioned for that reality, or will you be left holding the paper promises? Thanks for watching. Be sure to subscribe for more updates as this story unfolds. After the crash, the market pretended everything was normal again. Prices stabilized. The charts calmed down. And commentators? Well, they moved on to the next shiny headline. But silence is never normal after violence. When a market survives a shock this large without collapsing further, it means something, or someone, absorbed the damage. And in silver's case, it wasn't confidence. It wasn't optimism. It was control. Because beneath the surface, behavior changed. The same major banks that had been relentlessly leaning on silver for years suddenly stopped pressing. Not loudly, not publicly. They just stepped back. The short pressure faded, the sell walls weakened, and volatility compressed into an unnatural stillness. That doesn't happen when risk disappears. It happens when risk changes direction. See, these banks are not afraid of price spikes. They are terrified of exposure. And silver is exposure in its purest, most physical form. For decades, the entire silver market has survived on one incredibly fragile assumption, that all the paper claims would never be tested at once. That delivery would always be optional. The confidence would always refill faster than demand could drain it. But confidence is not infinite. Silver is not replaceable. This isn't just a store of value story. It's an industrial reality. Solar panels don't care about narratives. Electronics don't wait for price corrections. Military systems don't pause production because futures contracts dipped for a day. Silver leaves the system every single day, and it doesn't come back. This is the part most investors never learn because it doesn't show up on a chart. Silver supply does not respond to price the way people expect. Higher prices don't instantly create more silver. New mines take years to build. Permits take even longer. And capital, the lifeblood of it all, takes confidence. And that confidence was just severely shaken. The crash didn't just scare small investors. It scared the producers. Because when prices collapse that violently, producers don't hedge. They pull back. They delay projects. They conserve every ounce of capital. It quietly tightens supply at the exact moment global demand is rising. And this is where China re-enters the story. China doesn't trade silver the way the West does. They don't treat it like a casino chip. They treat it like critical infrastructure. China buys silver the same way they buy oil, copper, and grain as a form of insurance. Insurance against sanctions. Insurance against currency instability. Insurance against a global system they no longer fully trust. This didn't just start yesterday. China watched foreign reserves get frozen. They watched payment systems get weaponized. They watched trade routes become tools of leverage. They learned a lesson the West seems to have forgotten. Ownership matters more than price. So while Western markets obsess over the day-to-day spot price, China focuses on access. Who controls the physical flow? Who controls the licensing? Who controls the exit points? That's why the premiums for physical silver in China didn't collapse with the paper prices. They widened. Because real buyers don't negotiate with algorithms, they negotiate with availability. And this is how two different silver markets are born. One market trades belief, the other trades metal. One market clears with digital contracts, the other clears with trucks. And history tells us exactly how this story ends. When the paper and the physical diverge for long enough, the weaker one breaks. It always does. The silver market survived previous stress tests because demand was fragmented.
How?
Retail was a small player. Industrial use was manageable. China was still integrating into the global economy. That is no longer the case. Today, silver demand is synchronized. Solar panel expansion alone consumes quantities of silver that simply didn't exist a decade ago. Electrification adds more pressure every single year. Military demand, which is never publicly discussed, never retreats. And now, Investment demand doesn't need belief anymore, it just needs fear. And that crash created fear, not in retail investors, in institutions. Because institutions understand something retail rarely sees: the leverage ratio. How many paper claims exist for every single physical ounce of silver? When confidence is high, that ratio doesn't matter. But when confidence cracks, that ratio becomes fatal. That's why the big banks quietly adjusted their positions after the crash. It's not because silver suddenly became attractive, but because silver became dangerous. It's dangerous to suppress, dangerous to over-leverage, dangerous to misprice. Silver doesn't warn loudly. It just disappears. And disappearance is the worst enemy of a paper-based system. This is why the narrative suddenly changed. Instead of silver is dead, it became silver is stabilizing. Instead of talking about an oversupply, we started talking about temporary volatility. These are not bullish narratives. They're damage control narratives. They exist to buy time. Time for contracts to roll over. Time for exposure to be shifted. Time for inventories to be reclassified and shuffled around. But time does not create more metal. It only delays the reckoning. The most dangerous phase of any market is not the collapse. It's the calm that follows. It's because calm convinces people that the danger is past. In reality, the calm is when the real positioning happens. This is when the largest players move quietly, when the headlines are boring, when volatility is low. That's when true accumulation happens. Not because prices are cheap, but because risk is fundamentally mispriced. China understands this phase perfectly. They don't chase spikes. They don't react emotionally. They build their positions when the market is tired and everyone else is looking away. And that's what makes this moment different from every silver rally before it. This isn't driven by enthusiasm. It's driven by necessity. And necessity does not negotiate. At some point, a delivery request will be larger than expected. At some point, a contract rollover will fail quietly behind the scenes. At some point, an entity will demand physical metal instead of a cash settlement. And when that happens, the price will not adjust smoothly. It will jump, not gradually, not politely. Because price was never the real control mechanism. Availability was. This is why silver moves in gaps. This is why it shocks markets instead of trending predictably. And this is why every major financial reset in history involves stress in the precious metals markets first. Not because metal causes the collapse, but because it reveals it. Silver doesn't create instability, it exposes it. That crash wasn't a failure, it was a stress test. Who would sell? Who would deliver? Who would absorb the risk? The answers are now clear. Retail exited, the banks repositioned, and China accumulated. Now, the system just waits. Because once accumulation is complete, price becomes almost irrelevant. The next move will not be explained in advance. It won't trend nicely on the charts. It won't be announced by analysts on TV. It will appear as a sudden gap up in price, followed by a frantic scramble for a narrative to explain it. By the time the headlines catch up, silver won't be asking whether it's allowed to rise. It will be pricing something far bigger than simple supply and demand. It will be pricing trust. When trust breaks, paper becomes optional. Metal does not. Thanks for watching. If this perspective makes sense to you, make sure to subscribe for more deep dives into the markets. See you next time.